back. My name is Chris Sachinelli, and I get to build, buy, and sell simple profit businesses every single day. And today we're going to be testing out something a little bit new with the hope of trying to bring more value to our audience faster as we're building up this YouTube channel, right? So the thing that we're trying new, let's just get to it fast. We run this newsletter. It's Simple Profits. It's a newsletter that goes out once a week to 50,000, right now 50,306 investopreneurs across our community, our ecosystem that we're building, right? All focused around profit-led, simple, profitable businesses, right? What we started to do a couple of weeks ago, maybe 5, 6, 7, 8 weeks ago now, is actually integrate polls inside the newsletter. At first, I was like, hey, I wonder if people will engage. And then we started to see engagement. It's actually how we launched our community over at bootstrapper.community, where folks can build better together, navigate the 5 exits of ownership, right? It's how we launched that. I was like, man, this is so cool. I really wanted to lean into it more and see if we could, position and extract and deliver more value from it. So the thought process, and this is something we want to test out and get feedback with, so we just do it live, build in public style, right? Is we're thinking about changing our content structure and the calendar, right? As we start to build more brand equity ourselves. We want to run a poll once a week, ingrained in the newsletter. Start doing the newsletters over the weekend, like a Saturday or a Sunday send, likely a Sunday send. Run the poll, get feedback on what problems, people are solving and what they're thinking about, right? So actually identify the issues that matter. And then once we got results from the poll, share the results from the poll Monday, right? Tuesday, record a video that hopefully delivers value around the insights associated with that problem. Drop that, make that part of our YouTube content structure, and then build off of that by creating more long form, kind of core to what we've done for the history of the Simple Profits newsletter and how we built it to the 50,000 that we have, which is to identify something of value, go deep into it, and then create like a framework or a template that can actually be adopted or utilized to get you to value fast with it, to solve those problems. So we kind of want to navigate back to our roots a little bit and see if we can leverage more of a community audience driven approach, to this. Sometimes we're not going to be enough of an expert ourselves or have enough experience to actually, facilitate the conversation and help, drive solutions. So in those situations, we're going to bring in SME, we're going to bring in subject matter experts from the ecosystem, from the community that we're trying to build, and hopefully help other folks, get onto a platform to help solve some problems so that we can truly build better together. So this last week, first and foremost, if you're interested in that, definitely share, definitely like and subscribe to the YouTube. If you're new here, definitely share your feedback in the comments, or you could email us or get in contact with us at the community. But I'm looking for feedback on this build in public style. And in terms of what this last week's poll was, so it was, how often do you think about equity in your business or what your business is worth? And this actually rooted off of the previous week's poll, which was what's important to you, or if you could have one blueprint to help you solve in your business, what would it be? Let me actually go back to it. So these are the polls that we've been running. The previous week was, if you could get a perfect blueprint to follow to implement in your business, which would you prefer? And, out of this, it was valuations and what my business is worth, right? So we took this, and then that carried forward into this past weeks, which was exit planning, which was, how often are you thinking about, what your business is worth, so that we can then create today's video, this content, which is going to go into actually valuing a business. And when we look at the data from this poll, it's like two schools of thought. It's, I'm either thinking about it all the time, or I'm in that Berkshire Warren Buffett school camp of, I'm going to own this thing forever. I don't really think about, what it's worth, because I'm just in a business I love, and I'm more customer obsessed. I want to create a better, operational excellence to support my customers and their experience, right? But most folks are thinking about what their business is worth. At the end of the day, we're committing our lives to building better businesses, and at the end of the day, the valuation of our business does matter, right? So today I want to go into understanding a simple valuation, right? In terms of a little bit of background credibility, why we can record this video, we're not bringing in an SME, right? So I'm the founder of Bootstrapper Capital. We're growing a portfolio of brands designed to help business owners, ideally profit-led business owners, access affordable and flexible solutions to build, buy, and sell simple, profitable businesses, profit-led businesses, right? So we have a portfolio of companies or brands, and not only do we buy and build, buy, and sell ourselves, but we also support other folks build, buying, and selling. One of those portfolio companies is simplebroker.ai, which is a business brokerage. And that business brokerage quite literally helps other folks buy and sell, businesses. America's number one most active AI augmented business brokerage. It's a big focus of ours right now to build up. And we have an advisory firm, Simple Profits, that quite literally helps businesses unlock value by understanding what the business is worth and why, and then creating a simple plan to be able to execute a transformation to build better wedge or build equity over time, right? Hopefully to the exit, helping you navigate the 5 exits. So we have a little bit of a background. We do it for ourselves and we do it for others. So there's, something that we can stand on in terms of discussion today. Everything we're focused on here is around higher valuations, better terms on investment, larger exit multiples, right? That's the benefit. That's the outcome of doing this, of being, concerned about what your equity is worth and then trying to build better wedge or build better equity to impact those things. Now, as business owners, we're always exiting, right? So we definitely want to be exit ready. We want to get exit ready. We're promoting business owners to get exit ready. If you join the community over at bootstrapper.community, it's all about mastering the 5 exits that every business owner has to navigate over the history of the lifetime of their business. Or ideally, you want to be able to navigate if you have the full freedom to decide, right? Sometimes that freedom's taken away from us because we don't care about these things and other effects, put us out of business. So the goal of business is to stay in business, right? And by staying in business, you're going to navigate these 5 exits. So what I want to talk about today is how and why we leverage this concept of a simple valuation as being a simple place to start when we're, either looking at our own businesses or when we're working with clients to be able to design, simple plans to be able to build better businesses, unlock value, build wedge equity. And the concept of knowing what a valuation is and why and how it works is really pretty important to be able to put it to work for you, right? So as a business owner, you should be asking yourself, what is my business worth, right? I want to know as a business owner what my business is worth, even if I'm in that Warren Buffett school of thought, just to challenge ourselves with accountability to build better businesses. Knowing what your business is worth is an important place to start, because if you know what it's worth, the next question becomes, why is my business worth that, right? So the what it's worth answer is either going to be a pleasant answer, right? So when we're doing business valuations and we're working with clients, sometimes we're telling you, okay, this business is worth $1.8 million. Sometimes that's like a 1.8, wow, great. Sometimes it's like a 1.8, what, right? So you don't want to be surprised, first and foremost, and you want that to be a pleasant number. And if it's not a pleasant number, you want to know why it's that number. If it is a pleasant number, you also want to know why it's that pleasant number. And by understanding the why behind your valuation, you can back into the how, right? So how did we get to a valuation? What are the active moving parts, right? What are the variables for consideration that impact what my business is worth, so I can understand that, so that by understanding that, I can then take action upon it and actually pull levers inside of my business to build a better business, to build a more valuable business, to do these things, which is get to higher valuations, better terms on investment, larger exit multiples. These things don't just happen by happenstance. Sometimes they do, and some folks are lucky, but in the game of life, I'd much rather be able to take responsibility for what I can control, right? I can't control outcomes, but I can always control process. I can always control actions, right? So I want to be able to line into a process that I can take action on, that hopefully puts me on that road of getting to the optimal outcomes. So when we think about building equity in our business. We call it building wedge equity. And we call it wedge because quite literally it's the difference between like what your business was when it started to what it is when it ends. And it either stays stagnant or goes down or it goes up. And when you do that, the thing that you design is a wedge. The thing in the middle is the wedge, and that's the equity that you can build to actually unlock value, right? So you're quite literally building wedge equity. And when we think about wedge equity, we've simplified it down to two things. That's brand equity, which is really the money's multiple, and we'll get into that, and the things that impact the money's multiple. And then operational equity, which is the risk ratio, right? Things that discount ultimately, what something is maybe worth because you got to discount it for risk, right? And that's from the buyer's perspective. Those two factors ultimately impact your value or the equity or the wedge equity, right? So sounds simple. Simple works. Simple is definitely not easy, right? When we're talking about an approach to valuation, what we're going to start with is the money's multiple, right? We're going to back into the components of brand equity, which components of brand equity tie to your money's multiple, which is quite literally, what is the at the end of the day, the profit in my pocket, right? What is that worth to a buyer? And depending upon your industry, depending upon your stage and your size, that multiplying effect, that number is different, right? But everything starts somewhere. And typically the place that we're going to start with profit-led businesses, right? So this is specific asterisk to profit-led businesses, simple profitable businesses. This is a business that has a simple cap table that is not a venture scaled or venture backed, venture velocity unicorn, right? This is really for this is for the rest of us. This is private equity for the rest of us. This is venture for the rest of us. This is the 30 million plus, business owners that make up the vast majority of the backbone of the American economy, right? That's who this is really talking to. That's who this is for. So take it with a grain of salt with an asterisk, right? Typically, when we're doing these types of deals, what we're going to look at is normalizing around seller's discretionary earnings, right? And taking a seller's discretionary earnings approach allows you to start with your net profit, right? But then it's going to allow you to normalize it by adding things back in. And by adding these things back in, what it's normalizing is a better picture of the actual money and the flow and the cash at the end of the day in the deal, right? So that when a buyer is looking at it, they can make a better decision, right? Based off of better benchmarks. And at the end of the day, markets normalize, right? So markets are made. When we make markets, what we want to do is take a standardized approach to the buying and the selling of something. Because if I'm currently a buyer, right? I'm currently buying something. I'm going to have to value it. I'm going to have to price it. I'm buying something with the intent, ideally, to one day be a seller. So the way that I buy, I want to buy similar to other people, right? I want other buyers to buy similar so that we can look at things similarly, right? And allow the market to normalize in terms of price. Because if we're all benchmarking off of similar things, then a market gets made. And when I become a seller, I would be able to sell into a more efficient market, right? So it benefits us. It behooves us as buyers and sellers in the marketplace to kind of approach things in a fairly standardized way. Now, there's always asterisk outliers, right? There's always, you have the full freedom to decide at any given time, but it makes sense to do it in a normalized way because markets get made. And when you buy right, you could hopefully also build right to then sell right? And you want to always be exiting. So we're going to start with getting to your seller's discretionary earnings, which is to take your net profit, and then you're going to add back in your non-recurring expenses. You're doing this because these were things that were one-time expenses that aren't really indicative of future expenses that will be incurred by the business. So I want to, again, normalize these financials and give a better indicator of what cash flow is going to be looking like, what the profit loss is looking like in a normalized rate, right? So something that was a one-off, that's not normal, right? So you want to add that back in. Same goes for owner discretionary expenses, right? That, sometimes we put personal expenses on the P&L of a, of an LLC, or, a simple business. Those things don't really, they don't really belong there, right? Those are the owner's expenses. They're not the business expenses. So when a buyer takes on that business, they're not going to incur those expenses. So those get added back, right, to help, again, normalize the financials. And then the same with an owner's salary and benefits. And you want to do this because, the buyer may or may not take those things on, and you just want to normalize it so you can adjust it appropriately and then be able to benchmark to make good, timely decisions into price, right? So you're going to get to a seller's discretionary earnings number, and then you're going to apply a SDE multiple, a multiplying effect, right? So you're going to normalize around the earnings, right? Seller discretionary earnings, right? Profit in your pocket to a certain extent. And then you're going to multiply, you're going to apply a multiple effect. And that multiple effect gets normalized. This is where that normalized number comes into play from markets, right? So when we look at listings, or we look at businesses across, broad scale database of what's trading, what's buying and selling, just like any marketplace, we start to realize that, things have law of large numbers. On average, they're trading for these multiples, right? And by doing this law of large numbers based off of industry and revenue range, right, SDE range, you can start to normalize within a tighter accuracy, what something's worth, and or what a buyer's willing to pay. And that's how the market gets made. So the first step is to get to that money's multiple effect by getting your SDE, applying it to a multiple chart, which these numbers asterisk, these are always changing. Depending upon when you're watching this, this may or may not be accurate. We are updating ours on a weekly basis, pretty much across a large data set from Simple Broker, where we're aggregating like thousands and thousands and thousands and thousands of deals to be able to get to these numbers. So, asterisk there in terms of risk, but you get to that, and that's going to get you your money's multiple. And then you're going to move forward, and you're going to start to assess the risk ratio, right? The operational equity, right? When we're looking at operational equity, it's funny because we're actually thinking about brand equity from an operational component, and then we're thinking about core operational equity. So what do I mean there? I mean, that money's multiple is factored by SDE times, what the multiple rate is. From an operational equities perspective, there's operational excellence that goes into being able to achieve that money's multiple. And that operational excellence ties to generating revenue, right? So on the brand equity side, there's operational components that impact the amount of revenue you're generating, the efficiency of that revenue, and the risk of that revenue. So when we look at it, we've tried to simplify it to three things. And even though I've simplified in this presentation to a very simple formula of two, brand equity and operational equity to get to Wedge, it's very quick to acknowledge the fact that there's variables that come into this, because now we're breaking it down into, three things on the brand equity side, two more things on the operational equity side. But within, these three things, there's 4, there's 9, there's a variable 4, there's a variable 9, right? There's variable 3 when you're talking about diversification of customer portfolio, right? So it becomes exponential in terms of variable impact. So simple works, but simple is not easy. What we've tried to do is distill it down into the simplest, moving parts, so that you can master that, measure what matters, master it. And then, by then getting granular, you can actually understand it, appreciate it, and interpret it, right? And by getting very specific and focused, you could put strategy to work to actually, unlock the value and move the meter in terms of building Wedge, right? So I want to asterisk here the fact that, even though I'm talking over this in broad strokes, and we've been able to simplify it to fit into a presentation, it's really just not that simple. It really isn't. And there's a lot that goes into this, right? So from the understanding brand equity, you have the 4 pillars of customer acquisition. Also, all of this stuff is covered as well in the book, right? So the book on bootstrapping, we cover this in depth as a 400-page book. And then we also have, we've compounded on top of that to build upon that. We've created, workbooks, etc., to help folks just navigate these things. And then we also do it in the community over at bootstrapper.community, just to try to make it as simple as possible, because it's so important, right? At the end of the day, if I understand what my business is worth, why it's worth that, then I can get focused in terms of, how I can make it more valuable, right? What do I need to improve, right? What do I do more of? What do I do better? What do I do new, right? So it makes it super actionable. So we've tried to really support that, even though it's fairly complicated. In terms of time interest of this video, I'm asterisking those other resources, because in those other resources, we go really into the weeds. And I don't want to be on YouTube just going high level 20,000 foot, but also I don't want to record a 2-hour video for YouTube. I want to keep this, as tight as possible to give kind of the broad strokes understanding of a foundational place to start, foundational principles, profit-led principles. And then also, acknowledge the fact that there's other resources for you to go deeper, because this is a very deep concept. And when you go down this rabbit hole, it becomes extremely fascinating. Hopefully you find it extremely fascinating, as interesting as I do, perhaps, I hope. Because when you really master this, you start to realize, man, I could be in any business, anywhere, and I just get like why this thing is worth this. And I could just manufacture and build Wedge, like just build a better business. So it becomes really empowering. It's a really empowering thing as a business owner. So I do hope that maybe you do go down that rabbit hole, just asterisking, not in this video. In terms of the 4 pillars of customer acquisition, you got, warm, cold, earned, and paid, right? In terms of the 9 C's, that's all the abilities to build structure into your business to increase the lifetime value. 4 pillars of customer acquisition. The goal there is to decrease the customer acquisition cost, increase the amount of customers being acquired, right? So you're trying to lower cost, increase acquisition. In terms of the 9 C's, you're trying to increase the lifetime value of your customers by putting retention moats. Like retention is realistically making it difficult for them to leave or incentivized to retain, right? And then diversification of your customer portfolio is building a more valuable portfolio of business, because if I have all of my eggs in one customer and I lose that customer, I have no more business, right? So there's mechanisms in place to decrease the risk of your revenue by looking at your customer portfolio from a diversification perspective and adding revenue streams, the ways in which you bill, right? So one time versus recurring versus retained, etc., right? All of those things impact the risk ratio of your brand equity, of your money's multiple, of your revenue, right? Because again, the money's multiple based off of revenue, and the revenue flowing through your business to the point of an SDE, profit in your pocket, right? Operational equity is all of the operational components that go to supporting that throughput, right? So brand equity being the throughput, all of the functional things in your business system that allow you to support that throughput, support that revenue flowing through. That's your operational equity that you're focusing on building up, right? Now, there's 5 stages of every business in terms of an exit. And based on your stage, you're going to have different focal points, right? Sometimes things are relevant versus not based on stage in terms of building operational equity and building brand equity, right? So it's also important to acknowledge that. But you're going to look at your business system checklist, again, depending upon the stage of your exit, right? Exit 1 through exit 5. Your business system is going to look different. Exit 1, you have a very simple business system. Exit 5, you're really trying to maximize this thing to stop owning the business. So you sell it. You're really trying to, put everything in place. It's going to be a fairly, depending on your business, fairly complicated business system, right? Ideally still simple, but, simple's not easy, right? And then you're going to want to understand the other components of your business that tie to making your business system work from a risk ratio perspective, from an operational equity perspective. So you're going to want to make sure that your financials, right, are in order. Your financial risk analysis, the operational risk analysis, the people risk analysis, the innovation risk analysis, right? All of these things, ultimately, at the end of the day, if you're coming back to buying a business, and again, markets get made, your business is valued. We understand what a business is valued because we understand how a buyer perceives it, right? Because markets get made. All of these things are things that on the buy side of a deal, you're doing in diligence. So what we did when we built our approach to work with clients is really we just took our diligence process for ourselves, right? So as a portfolio of companies, we actively look to buy and acquire businesses. We have an extremely intensive diligence process, like hundreds of checklists deep, realistically, to go through in diligence. So all of these things that you're looking at in this one slide, they exponentially go out in terms of questions and what we're looking at, interpreting, analyzing. We took our diligence process and we tried to productize it in the form of helping others complete a diligence on their own business to then be able to do this one thing, which is then to pull the levers of that to create Wedge. Because if you understand, what your business is worth and you've identified why it's worth that, and again, the root is because that's what a buyer is looking at. So that's what a buyer will pay, right? Price is just what someone else is willing to pay, right? So you want to know what people will pay from the buy side. By following a buy side process, you can identify the areas that are, beating you up in terms of price, adding risk to the deal. What would make this deal more appealing, right? Attractive to a buyer, increase price. By identifying those things, you can then put a plan in place to focus on those things. And then by focusing on those things, you could pull the levers that allow you to optimize the business and build a better business and actually unlock value, right? So just like how we're approaching a valuation, it's the same things that we're going to be focusing on in order to build a better business and unlock value, right? You're going to want to make sure that you have different structures and strategies and frameworks in place for each of the 4 pillars. Once you do it for yourselves, you're going to want to double that up and allow channel partners and other folks, right? You could do these 4, and then other people could do those 4. So you want to double it up. That's going to maximize your customer acquisition, right? Most customers at the lowest possible price. That's the goal there. He who can acquire, spend the most to acquire customers wins. But, realistically, you want to ring fence and you want to drive costs of customers down as you're increasing velocity. 9 C's of retention, right? That's all about value. It's supposed to be an and, right? So that's all about increasing the lifetime value of your customers. There's ways that you can look at your business to increase, like different structures, strategies, and frameworks that you can implement in your business to increase retention, increase value of a customer, right? Same with diversification of your customer portfolio, different pricing strategies, revenue strategies that you can implement into your business to improve it, right? From an operational equity side, you have your simple operating system, your business operating system, and then you're building it by exit. Because again, a business system is going to be different for exit 1 than it is for exit 3 than it is for exit 5. So you got to know where you are in terms of your journey, right? So you need help to identify where you are in terms of your journey. And then once you know where you are, you need to build it to suit. And when you're building it to suit, you're building it with your profit-led financial, part of your operating system. You're building it with your revenue engine, right? You're building it with your process-led operational system, because you can control process, right? You can't always control outcomes, but you can control process. And you're implementing these different various components into it based off of stage, based off of your exit. And then that ultimately allows you to lead, know your numbers, measure what matters with profit-led financial accountability, because it's all about structure, strategies, and accountability to get you to simple, profitable outcomes. Now, you do all of these things, it gives you a map. It gives you a roadmap that you can follow. It gives you a plan, right? Or a strategy. It gives you something that you can actually follow, know where you are, and implement, take action upon. Getting here is not super easy, but once you're there, it becomes a matter of just accountability. You got to just trust the process and commit to the journey. And if you commit to that process, if you trust the process, commit to that journey every single day, and you're committed to just taking action, focused action, because strategy equals focus, then ultimately what you're going to do, if you're doing the right things, is you will impact these specific things that impact the value of your business. And the natural byproduct would be a more valuable business over time, right? So this is the perspective, change your perspective, change your approach type of conversation that we want to definitely have. It feels as though there's a lot of business owners that, when we have conversations, it's like, this is on our mind, but we don't necessarily know how to approach it. And that's perfectly okay, right? Everything starts somewhere. And what we want to do is give a place to start. Hopefully this video is there. If you're interested in this, if you want to build a better business, definitely come and join us over at the Bootstrapper community, right? It's a place where we're navigating, we're mastering these 5 exits together. And we're trying to teach, train, equip a lot of this stuff, like in public as a community through like community advisory, in a very affordable and flexible manner, right? So we're trying to be able to decrease price realistically to get access to a lot of this stuff, and if you need a little bit more help, then we have all of our portfolio companies that are specialists that can then be focused to be able to provide the, specialized subject matter expertise in terms of like implementing a revenue engine or, helping optimize, process and workflows and automations inside of your business system, or, adopting profit-led financials in terms of bookkeeping, right? All of these as examples. Come join us at the community. If you got value out of this video, I appreciate you watching to the end here. Definitely please like and subscribe. We're trying to build up this channel. Hopefully we can do something that creates a lot of value for a lot of folks so that we can, build better together. Till next time.